Welcome back to Market Brain, where we dissect the bleeding edge of financial innovation. Today, we're diving into a concept that sounds almost absurd: vibe investing. Yes, you heard that right. We're talking about AI that doesn't just crunch numbers, but attempts to feel the pulse of the market, translating the intangible into actionable trading strategies. It's a fascinating, and perhaps slightly unsettling, glimpse into the future of quantitative finance. So, what exactly is vibe investing? At its core, it's the idea that market sentiment, the collective mood of investors, holds significant predictive power. Think of it like this: if everyone suddenly feels optimistic about a particular asset, that vibe can drive prices up, even without a fundamental change in value. Traditionally, capturing this sentiment was a qualitative art, but now, AI is attempting to quantify it, turning the whispers of the market into tradable signals. This is especially relevant in today's dynamic markets, where sentiment shifts can trigger rapid price movements. How does an AI feel anything? It's not about emotions, but about sophisticated pattern recognition. Large language models, or LLMs, are trained on vast datasets of text, news articles, social media posts, analyst reports, and even earnings call transcripts. They learn to identify linguistic patterns associated with positive, negative, or neutral sentiment. This allows them to ingest a constant stream of market-related text and output a quantifiable sentiment score, effectively translating the qualitative vibe into a numerical input for a trading algorithm. Mathematically, we can represent this process as a function. Let $S_T$ be the sentiment score at time $T$, and $EXT, text, $T$ be the aggregate market text data available at that time. The LLM acts as a complex, nonlinear function, $F$, that maps this text data to a sentiment score. So, we have $S_T equals F, EXT, text, $T$. This score can then be integrated into a broader trading strategy, perhaps as a weighting factor or a direct buy-sell signal, allowing algorithms to react to the market's perceived emotional state. This approach marks a significant departure from traditional quantitative finance. On one side, we have strategies built on hard numbers, earnings reports, balance sheets, technical indicators, and macroeconomic data. These are objective, verifiable facts. On the other, vibe investing leverages the subjective, the narrative, and the often irrational human element of the market. It's about finding alpha in the squishy, qualitative data that traditional models often ignore, offering a new dimension to market analysis, especially when fundamental data alone doesn't fully explain price action. But vibe investing goes beyond simple sentiment scores. The most advanced systems employ multi-agent backtesting. Imagine a simulated market where different AI agents, each with its own vibe interpretation and trading strategy, interact. One agent might be a bullish newsreader, another a bearish social media scanner, and a third an arbitrager looking for discrepancies. This allows researchers to model complex market dynamics, test strategies under various simulated conditions, and understand how collective sentiment emerges and influences asset prices, providing robust insights into market behavior. A key application of this multi-agent approach is identifying asset coupling and arbitrage opportunities. For instance, an AI might detect a strong, dynamic correlation between a major equity index and a cryptocurrency, even if that correlation isn't immediately obvious to human analysts. When markets are particularly volatile, these couplings can strengthen or weaken rapidly. By understanding these relationships and how sentiment influences them, AI can potentially spot temporary mispricings or divergences, allowing for sophisticated arbitrage strategies that capitalize on these vibe-driven interdependencies. So, is vibe investing the future? It certainly represents a powerful new frontier in quantitative finance, blending the analytical rigor of math with a nuanced understanding of human behavior. While the idea of AI feeling the market might still sound like science fiction, the underlying mechanisms are rooted in advanced natural language processing and complex systems modeling. As markets become increasingly driven by information flow and rapid sentiment shifts, these tools offer a compelling way to capture previously unquantifiable alpha. It's a reminder that in finance, innovation is always just around the corner, even if that corner leads to an AI with a gut feeling.